was talking to one of my institutional investor friends, and it dawned on me that two of the most important words in investing and trading is not something that I think many, certainly not self-directed investors, retail investors, have ever even heard about. Hey everybody, Serge Berger here of the Steady Wealth Podcast. I was on one of those institutional phone calls, research phone calls, and they're very interesting, but they can go quite long. And as I was listening but not listening for a while, something sparked in me inside of the conversation topic, and which had a lot to do with something called factor exposure. Two words: factor exposure. What is factor exposure? Why is it extremely important to understand? Let's take a few minutes and discuss this here today and see if we can't make some sense of this. The very basics of it, and I'm going to be talking about this here and discuss some charts. I will show some charts if you're watching this on YouTube. If not, I will be describing it just as well. But I think what's important about understanding factor exposure is I think everyone has heard of something called sector and group rotation, and or sector exposure, or groups exposure, or asset class exposure. And I think very few people have heard of this thing called factor exposure, which quite frankly is arguably maybe even somewhat more important than the other ones, at least equally important and imperative to know. When we talk about exposure in general, what we're talking about in the market, it relates to our portfolios, where we see strength, where there is weakness. When we talk about exposure, we really talk about where's our sensitivities, where's there risk for us as traders and investors in our portfolios, in our trades, in our investments, as well as opportunity, of course. And factor and group, or sector and group exposure, is something that lots of people have heard about. But again, it's the factor stuff that I think is something that people are simply just, I don't think it gets discussed as much. It's a big thing in the institutional world, but not with the retail investor. So let's talk about this. Essentially, factor exposure has a lot to do, with understanding that there are other things than sector and groups that we invest in. So it's almost like knowing what factor and group factor to expose ourselves to allows us to create uncorrelated returns to the broader market. And I think that's really the key here, uncorrelated returns to the market. And I believe, if I think back now, when I was on that research call a few days ago, I think that's what sparked it. Now that I'm actually honestly thinking about this the first time, I was trying to think what sparked it. I think it was the non-correlated returns or risks in a portfolio versus the broader market. If you think about sector and group exposure, let's keep it really simple and just talk about the stock market. As I always like to say and remind people, is that the stock market is the most highly correlated major asset class in the world, which basically means that if the stock market, let's say, goes up 1% in any given day or down 1%, most stocks are probably going to go up or down, right? Along with the index. Not every stock, but the majority will. Whether that's 60% or 80% or 90%, depends, of course, on the reason for the move, on the magnitude of the move, where you are in the cycle, et cetera, et cetera. So in some sense, just moving from stocks or a trade from one sector to the next in a stock portfolio might give us a different opportunity, but it still exposes us to stocks as an asset class, right? But that is sometimes not really all that smart to do if we have big risk-off moments where, again, pretty much everything falls. And when we look at, for example, I'm just displaying here a simple chart of the sectors of the S&P 500. We can see how they correlate. And again, if you can't see this chart, what I'm showing here is basically just a bunch of correlated lines from the energy sector to the technology sector. And we can see how they all move up and down together for the most part. Some of them move up more. That's when you talk about rotating into that sector. And then other ones falter. Like right now, as I'm recording this, real estate is down 10% for the year. Energy stocks are up still about almost 13%. Technology is only up 2% for the year, by the way. Don't tell the bulls that. But the point is, they're pretty closely correlated. There is dispersion, but there is, from a directional perspective, there is obviously correlation. So those are sectors, and sector rotation is a very important thing to do. And we can actually play the economic cycles with sectors. So, for example, financial stocks tend to do well at a couple of specific points in the economic cycle, particularly when rates essentially see a re-steepening of the yield curve. But other sectors will do better at other parts of the market, other parts of the cycle. So it's important. But again, they're still stocks. That's the point here. Now, we've talked about sectors here, I think, for quite some time, and I think everyone understands this. And we've talked about it quite some time here in these podcasts. But there's also something called industry groups. So industry groups are, like, for example, like insurance stocks are an industry. They're not a sector. They are an industry within financials. Or regional banks are a industry within financials as a sector. Home builders are an industry. Oil services are an industry within the energy sector. Clean energy is an industry within the energy sector. And sometimes it's not as clear, because clean energy can be a stock can sometimes have multiple factors, which is something we'll get to here in a second. So that is group and sector rotation, or group and sector exposure. So for example, let's say someone made a lot of money in tech stocks over the past number of years, which anyone that was allocated tech stocks is most likely what happened, US tech stock or US indices tech stocks. And because of that massive outperformance, let's say someone's allocation to tech stocks would have thus become much, much higher relative to the portfolio. So it's time to rebalance. So the risk in sector and group rotation there's lots of different aspects of looking at it. Again, it can allow us to move from sector to sector in different parts of the economic cycle, but also being aware of sector group rotation from a rebalancing perspective is important. I think that's what I'm trying to say. Although that was a bit slow, I know. But let's move on to what I really want to talk about here today, and that is something called factor analysis. Factors are a bunch of different things, and I'm showing something here, a few factors. There are many more. Some of them are quite esoteric, but let's talk about some factors. So what are factors? Factors are things that, again, are market neutral in the sense that they're not very correlated. They might be to some extent, but not very correlated to the broader market. For example, some of the more common factor exposures are, for example, and I'm going to start with the ones that are correlated to the market, but bear with me. For example, value and growth, right? Stocks, let's say. When value stocks do well, better than growth stocks, that there tends to be a certain part of the market where that happens. So knowing what factor I'm exposed to in a portfolio or as a trader or investor is extremely important. If I am trading growth stocks, but we are in a situation where value stocks do much better, which hasn't happened in a long time now, by the way, but it's probably overdue now for it to happen, then I'm not paying attention, right? I might be in the right sector, but if I'm playing in a sector where the factor is wrong, that doesn't make much sense either. Size is another factor. Small company versus large companies. Think about small caps versus large caps. Again, I'm ironically starting with the ones that are exposed to the broader market, but bear with me. Momentum stocks. Believe it or not, this one here is actually quite idiosyncratic in the sense that it's not that correlated to the broader market. There are always things that have momentum, whether that momentum is to the upside or to the downside. So that's a factor that we can take advantage of. There are nowadays, the beautiful things, there's ETFs for that. I can't think of the bearish momentum ETF, but the bullish momentum ETF, which I think a lot of people are aware of, the ticker symbol is MT as in Theodore, UMTU, and the stocks within that have momentum keep changing. So this year and for some time now, some stocks like NVIDIA have been in there, but they're not always in there. They're going to change at some point. So momentum is actually a factor that can be played as somewhat idiosyncratic or somewhat less correlated to the broader market than say being long the S&P 500 or just long tech stocks. Excuse me, time for more tea. So those are some of the more obvious factors, but what about things like quality stocks? So here we're talking about stability of earnings, debt levels, profitability levels. That too is a factor that can be much less exposed to the broader market. Volatility, believe it or not, is something. Now, volatility is really where things open up because there are options strategies we can play, factor exposure trades that we can do through volatility. Meaning, if volatility is high in the market, I can take advantage of all sorts of directional strategies, maybe, but I can also be maybe a seller of volatility. If volatility is low, there are long volatility strategies, meaning basically buying volatility. These kinds of strategies are much less correlated to the broader market. And again, the good thing is there are ETFs for just about any single possible one of these factors. In fact, we are going to be holding a series of webinars starting really soon in the coming weeks. You'll hear about it for sure. And we are going to be hosting different ETFs. We're going to have, sometimes it's a fund manager, sometimes it's a representative of the company come to us and talk to us about different strategies of different ETFs. This is not a marketing exercise for them. We're not getting paid for this. It's, I believe, important for people to understand that there are so many other ETFs out there, again, particularly related to things like factor exposure, which is actually why I wanted to start this today on this topic, that really allows us to diversify away from just being long tech stocks or overweight tech stocks and underweight whatever other kind of stocks. There's so much more to that. And it really allows us to be better hedged. Income as a strategy, for example, as a factor exposure is something. Smart beta strategies are another one. And then, of course, we go into the fixed income world and the commodities world, where it's almost unlimited of the kind of exposure we can do. We can have factors such as yield curve steepening factors, things that do well when the yield curve steepens, like stocks, for example, that do well or do worse when yield curve steepens or when it inverts. Again, it's almost unlimited. Corporate debt strategies that are, again, as a factor exposure, less exposed to the broader market. So I think factor and group exposure is, in my opinion, one of the very, very most important exposures to understand. If I would have had this conversation here or this podcast 10, 15 years ago, the discussion would have been much more complicated because to invest in factors, one would have had to go to either an expensive mutual fund or do it oneself, and that becomes complicated, trust me. But nowadays with ETFs, and a lot of these are lower cost ETFs, we essentially have that exposure. I will say just quickly on this, because one of the things that we see is as soon as you talk stocks or ETFs, people say, are there options on those? I want to be very clear. Options, I obviously am a pretty, frequent, I should say, options investor, trader, whatever you want to call it. No, they're trades. Options meant to be traded. But I will say that when it comes to factor exposure, I just about never have options or leverage on those factors, depending on what the factor is. Let me qualify that. If the factor exposure is I want to be exposed to growth stocks, that's essentially being long the NASDAQ 100 or maybe healthcare growth stocks. But even growth stocks, just quickly backtrack, is actually an exposure. Because if someone says, okay, I want to be long tech stocks because that's tech equals growth, what people forget there is that there are other growth areas. Like a big growth area is healthcare, energy, right? Those are big growth areas. It's not just tech. Ultimately, a lot of these companies use tech. So you already make the argument that it's tech, but it's not classified as a tech sector. So if I'm playing the growth theme and I'm only in tech stocks, I'm missing out big time from a reward perspective, but I would argue also from a risk reward perspective, because our risk is much better balanced if we have it diversified among other growth sectors. Again, these are exposures, not so much stocks going up and down together as a sector. There is a big difference there. Just quickly back on options. Again, I don't think we have to use much leverage when it comes to factor exposure, depending on what it is. Some of these ETFs don't have that much options liquidity anyway. Some of the ones I'm thinking of right now. Another idea is, as a factor exposure, is, for example, being exposed to the idea of more volatility in a specific asset class, be that commodity volatility or fixed income volatility via something called the MOVE index. These are factors we can expose ourselves to that are diversifying us away from the broader risk on, risk off, constant conversation on financial media outlets like TVs and things like that, and still give us an opportunity to have amazing risk rewarded return potential. Again, that's one of the reasons, actually the reason why I'm going to start interviewing and hosting and having. I am really looking forward to. I've been wanting to do this for years. Fund managers, ETF managers specifically, that run different strategies, and they can explain to us what these work, how these things work. Volatility as a factor exposure. Something else I think that's really interesting as a factor exposure is dividend plays. I think a lot of people can get their head around what that looks like, right? Being exposed to dividends, but not just to dividend stocks in general, but maybe to dividend stocks that are in the value space, or dividend stocks that are in whatever the case might be. Again, these are all factors that we can get much more granular to. Now, you might be asking yourself, Serge, this sounds good at the surface, but how the hell do I find that all of a sudden now I need to be in dividend sectors? There are many ways in which you can do that. One of which is being, for example, a member of our Inner Circle membership over at the Study Trader. But we're going to do a lot of effort here in these podcasts and on our YouTube channel to become much more granular, because I think we've reached a point in time where the individual investor, self-directed investor, has gotten a good amount of them. Although a good amount of them are still very new, but a good amount of them have begun to understand the correlation risks in the markets. And so educating them now, or bringing to light and showing our research on other factors, how we can find trades if stocks go down that might do well, but have nothing to do with directionality. What if I could buy an ETF that is just long volatility, or long another sector, again, a dividend thing, or again, an increase in volatility in the commodities market, right? Again, these are ETFs. It used to be, not that long ago, if I wanted to expose myself to the bond market volatility, I'd have to get deep into bond market territory, specific broker accounts, leveraged accounts, future accounts, blah, blah, blah. Nowadays, we buy an ETF, right? And an ETF is essentially trading like a stock. So we can hold it for a few weeks, a few months, a few years, however long the factor exposure makes sense to us for. So factor and group exposure, I keep saying factor and group, sector and group exposure rotation. Again, I think a lot of people are familiar with that, but the one that I really want to bring to light here in this quick sort of 15, 20 minute podcast is the sector, I can't get it right, the factor exposure. So we'll talk much more about this. Again, looking ahead here, I don't know how soon, but soon enough, we will start inviting all sorts of ETF fund managers and representatives that are going to explain to us their strategies. And it'll be, I think, very educational from here on going forward, specifically around factor exposure, but also around sector and group rotation and rotating into different asset classes and so on and so forth. I consider myself to be very fortunate living in this day and age where we are active in derivatives too, with futures and options, but I think it's a wonderful thing that we have ETFs that give us exposure to all these different things and things we can't even imagine. There's a blessing here, at least, or a silver lining as far as I'm concerned. And again, we're looking forward to bringing you a lot of education on this through the lens of ETF providers and managers. Thanks for listening, folks. Be well. Have a great rest of the day wherever you are, and look forward to seeing you in the next Steady Wealth podcast. Thanks for listening.